Hey everyone, this month I am partnering with Questrade and they've got a special offer for In the Money listeners. Questrade is focused on building the future of investing right here in Canada, and they've rolled out some real game changers. We're talking about the new trading platform, Questrade Pro, which is in beta right now for select users. If you want to join the beta group, you can sign up on their waitlist. Now, when it's fully released, you will be able to trade directly from best-in-class charts. You'll have lightning-fast execution. You'll have AI tools, a full trader performance dashboard, and the best part, it's totally free to access. Now, in the first quarter of 2026, you're going to be able to trade assets like real physical gold right inside your Quest Metals account, just like a stock. And then they're first in Canada to make cash-secured puts available in all of your registered trading accounts, except for an RESP. That's a huge, sophisticated income-generating tool now available to everyday Canadian investors. But the one that really floored me was their 2026 announcement for custom indexing. You can take the S&P 500, dial down the weighting in one sector, dial it up in another, and buy those stocks directly. Why would you pay an ETF fee when you can essentially build your own customizable index for free? Use my special promo code INTHEMONEY, all one word, when you sign up for your first self-directed account, and you'll get $50 as a cash reward. Or you can open up a Quest Wealth Portfolios account and you'll get your first $10,000 managed for free for 1 year. Go to questrade.com. Remember, promo code INTHEMONEY. Hi, everyone. Welcome to a very special edition of In the Money with Amber Kanwar. We're going to be doing things a little bit differently this episode and for the next 2 episodes, focusing on alternative investing. You guys know I love stocks. I love talking about the stock market. That is only just a slice of what is possible for investors. So for the next 3 episodes, we're going to focus on what else is out there. We're going to talk to the head of a $1 trillion titan that is investing in private assets and how everyday investors should think about the role that it plays in your overall portfolio. We're going to talk specifically about real estate as an asset class. And then we're going to talk to one of the senior partners at maybe the best to ever do it, Brookfield. But guess what? There's a twist to all of this. I'm not going to be hosting this special. I am going to be handing it over to my very good friend and now colleague, I guess.
Yay!
Paige Ellis, the triumphant reunion. Paige, it's so nice to see you again.
It's so great to be here and be back behind their microphone.
I know.
Be back on set with you. This is such a treat.
So for people who don't know, Paige and I worked together at BNN Bloomberg for
at least a decade.
At
more
least
than
a decade. We are friends now and back to being coworkers. And I basically asked you, I said, I'm so heads down in the market and these portfolio interviews and CEO interviews. And but I knew there's this other thing that's out there, alternatives, and it's exploding. And so I asked, would you host this special?
Oh, and I jumped at the chance. And in part because it is such a fascinating area. The private markets, alternatives, the illiquids, as some people describe them, massive and growing, dozens of trillions of dollars of AUM already in the private markets. That's expected to balloon. And there's even some interesting changes around where you can invest the money. So for example, in the US, there are retirement plans, 401ks. There's some discussion about allowing private market investment via that. So it's just a really fascinating area. And I think we cover a lot of ground here.
I think that's important to point out. Private investment in any kind of vehicle didn't seem like a DIY thing, right? But to your point about what's happening in the US and even here in Canada, there is a greater push to get these products in front of retail investors. And that can be a great thing because, those assets tend to do better. But it also comes with challenges that are not there, just to be a stock junkie again, that are not there when you're investing in the public markets. Like liquidity and transparency are 2 of the biggies.
Yeah. So liquidity, transparency are some of the big ones, some of the criticisms or trade-offs, as some people would describe. It's interesting, though, that in terms of the positives, the pros of investing in the private markets, we get into a lot of that with our guests. We talk about how, it provides diversification. There's little correlation with the public markets. And one topic I really get into with one of our guests is that public companies are disappearing, Amber. I know you love your public equities, but something like half of the companies that are listed on the major stock exchanges have disappeared.
I know that's
over the last few decades.
And in fact, it's like even getting access to new issues, companies are just staying private longer, right? We might get an IPO in the next couple of years of $1 trillion company. That's because it's not coming to market earlier because there's so much money in the private markets willing to fund whatever their series A, B, D, like A, B, C, D, all the way up the alphabet before they have to come public.
Exactly. And so that's where a lot of people are now saying, the opportunities are in the private market. But of course, there are a lot of considerations. As a retail investor, you have to think about your portfolio construction. You have to understand, how much liquidity do I really need? Is there anything that's going to happen potentially in the future that I'm going to need some cash on hand?
And like, what is an alternative asset too is something that we're going to define in this series, because it seems like all kinds of things can be defined as alternative assets.
Oh, yes. And to that end, I have devised a little game for Amber and I to play.
Oh my God. Classic Paige Ellis, by the way, if you know this. Okay, let's play.
Okay, so I'm calling it alternative or artifice.
Okay.
Because I like alliteration and we weren't allowed to do that on BNN. So I'm going to read you a headline or a blurb. It's either true, it's an actual investment, an actual alternative investment, or I've just completely made it up.
Okay.
And it's up to you to determine what's real and what's not real.
Okay.
You ready?
And if you know me, I am very competitive. I was the reigning biz quiz champion at BNN Bloomberg before they just did away with it after I won. There's no more biz quiz. But okay, let's do this.
Okay.
I'm ready.
Okay.
Hit me.
This is a headline. Gotta catch the returns. Tokyo Asset Manager launches $50 million fund targeting ultra rare Pokemon cards.
Cards? Pokemon cards? I'm going to say no. That's an artifice.
Why?
Because it's Pokemon cards. No disrespect to your son, who I know is obsessed with Pokemon cards. Obsessed? That can't be real.
Okay, so it is not real.
Oh, God.
However, can I put a little asterisk on this?
Yeah.
Pokemon card returns have been enormous. Something like 3,000% for the ultra rare cards over the past 15 years.
Did you get this from your 4-year-old's PowerPoint presentation? Mom, this is why I need more Pokemon cards.
He has me. I brought a Mew. This is a rare card, I'm told. I don't know. Okay. Or I was deceived into spending a lot of money on this card. It is wild how much these appreciate.
Okay, so if you're listening on audio, you can't see, but picture a Pokemon card, and that's what it looks like.
It's a pink character.
It's a pink character. Okay,
genome hacking is the power. Anyways, okay, let's move on to the next one. Another headline. Investors raise a glass. Cask 100's $20 million whiskey and wine play promises liquid alpha and PE level fees.
I'm going to say yes, that is real. And I will just tell you because I feel like I'll get in trouble for this, but I feel like finance bros will do anything to legitimize their hobbies. And
drinking is one of them.
And drinking is one of them. And so they would call this an alternative.
You're right. It's true. It's true. You're 2 for 2. This is great. This is great.
Yes.
So yeah, it's Winston Art Group. They launched a $20 million 5-year closed-end fund. But what I thought this kind of brought to the surface is these fees. Fees are higher in the private market. And the speculation is that as retail investors become more entrenched in this area, that there is going to be fee compression. So we do get into that in some of the conversations I have with our guests.
I mean, yes, I can imagine that somebody dreamed this up and is like, what if we buy all this expensive whiskey and then we just charge people for it?
A lot of money.
A lot of money. Okay, I love this.
All right. Okay, next one. This is the first paragraph of a story. This is not a headline. A Canadian firm is going long on mortality, taking private a cemetery, cremation, and funeral company. In a note to clients, a BMO analyst said the PE firm is tapping, quote, an uninterrupted supply of customers.
Oh, savage. Okay.
Oh, grim.
Yeah. I think that's true. It's true.
It's true.
Because I do know there's REITs. There's a publicly traded company that specializes in funeral homes.
Yeah, it might be the one that we're talking about.
Is it Park Lawn? Yeah.
It's Park Lawn. So yeah, they were listed on the TSX, but they were taken private over the last year or so.
Yes.
And the deal was valued at something like $1.2 billion. Yeah. And this, to our earlier point, companies
so graveyards as a private asset. All right.
Yeah.
Whiskey as a private asset. Maybe one day Pokemon. Are there more?
Maybe. Okay. I have 2 more.
Yes.
All right.
Am I winning? I'm winning, by the way.
Winning.
Okay,
You're 3 for 3.
Okay.
Maybe I needed to make these harder. San Francisco firm launches $75 million fund to monetize carbon credits from dairy cow burps.
No.
Just no.
No, that can't be real.
It's false.
Okay,
it's
good.
False. Although methane emissions.
Yeah, if it was
from
flatulence, if it was that the other way, I might have considered it. But no. Okay.
Okay, final one.
So many things we couldn't have said on BNX. All right, let's go.
Last one. Biofirm announces evergreen fund built on aggregated municipal fine receivables from parking fines to library fees.
What? Okay.
So they're making an evergreen fund.
Yes, on receivables.
So the municipal fines that come into the cities.
I don't know, Paige. I don't know. That seems like a complicated headline to make up. But I feel like you did make it up. Did you make it up?
I made it up. Largely because I'm a book nerd and I thought there's just like,
I know
scratch an itch.
Okay, I feel so good. And I am so excited to hand this over to you because I know that you're going to bring that same zest. And I'm just going to walk off in a sense that you won't hear from me for the next 3 episodes.
Yeah.
And I'm going to hand over. Take care of the show.
I will. I promise. I will be a good steward.
Who are we going to hear from first?
Oh, I'm so excited. We're going to hear from Mario Giannini. He is the executive co-chairman of Hamilton Lane, which is a massive private market firm based in the U.S. They have over $1 trillion in terms of their asset footprint. He has a great view of the entire private market universe. We're going to talk about a lot of the different kind of segments of the private markets. He also gives a really, I think, helpful breakdown of what he thinks your portfolio should look like with private market exposure.
Okay, so when I start the show, I say, let's get into it.
Okay, let's get into it.
The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and the guests are their own and do not necessarily reflect the opinions of any organization or company. The host and guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. When you choose a Raymond James advisor, you're getting more than independent financial management. You're getting access to complete financial guidance under one roof, from tax and estate planning to trust services for generational wealth and strategies for life's key milestones. Whether that's buying a home, funding your children's education, or preparing for retirement, they bring it together in one financial plan. What also makes Raymond James Advisors unique is their complete independence. With no proprietary product to promote, you'll benefit from personalized services, all backed by the strength and resources of Raymond James, a powerhouse with $88 billion in assets and over 520 advisors nationwide. Discover how Raymond James can help you live a life well planned. Visit raymondjames.ca.
Mario, thank you so much for joining us today. We really appreciate your time.
A pleasure to be here. Thank you.
So I love asking our guests about their formative investing experiences. I think it really helps inform the perspective that they bring to the table. Some of those early victories or early traumas can really shape how someone deploys capital. So if you think back to your early days of private market investing, and I know you like to describe yourself as a reformed lawyer, so we'll skip past that phase. Let's go straight to the
mentioning that. You had to throw that in, didn't you?
But listen, I'd love to know if there was a deal that happened in those early days that you still tell people about at cocktail parties.
I don't know that I tell about at cocktail parties because what's interesting is what you said about formative things being sometimes mistakes. And so the one I really remember was a huge mistake.
Hmm.
And I think you do learn more. I learn more from my mistakes than I do from things that go well. And I remember an early deal where I fell in love with the deal. I fell in love with the person selling the deal. It was complex. It was incomprehensible, really. And I thought, I'm so damn smart, I can comprehend it. And it went sideways really quickly. And I learned a couple of things from that. One, I learned that I was in an industry where I was around the greatest salespeople in the world. And I think people need to know that in the private markets, you have entrepreneurs, you have people who are phenomenal salespeople. And that doesn't mean they're lying. It doesn't mean they're not telling. They believe what they believe. And the other thing I learned is that I love complexity and that that's not necessarily a good thing and that I need people around me that go, they have a different perspective. And I learned those two things, and I feel like I'm glad that deal went. It was horrible at the time. I'm glad that deal went sour because it taught me two things that I feel over the last 30 years, because that was literally almost 30 years ago, have always kind of stayed with me. You need people around you to tell you, hey, dumbass, you're missing something really obvious here. And man, when people believe something, they can sell you virtually anything. And you go, oh my God, that has to be right.
Hmm. So, speaking about salesmanship, I was listening to this interview where you sort of noted that you're not really out there anymore as the spokesperson for private markets. You're no longer having to answer the question, why have private market exposure? Can you tell us when that happened and why?
Yeah, interestingly, bad reason, but good result for the private markets. I think it happened during and after the great financial crisis, because what it felt like happened during the great financial crisis is everything went to hell. And people looked at their portfolios and they said, yeah, like public equity sucks. I lost 40%. That's terrible. Bonds were terrible, and people didn't care about bonds anyway at the time. Hedge funds were terrible. They didn't do anything they said they were going to do. They told me I was going to get a, okay return, and I got negative. And real estate obviously fell apart. The only thing that kind of did what people thought it would was private equity at the time, more than credit. Those really weren't a big thing. And at that point, it felt like the light went off with institutional investors who said, hey, of all the things I had, the only one that did what it told me it was going to do were the private markets, the private equity guys. And I think that changed the entire narrative of how people thought about private assets. All of a sudden, they said, I need it. I'm not going to question that part. I'm just going to question, what do I want? How much do I want? It was, I think that period after the great financial crisis really marked a sea change in how people viewed private markets.
Hmm. And I do want to dwell on one reason that you have often cited as to why retail investors in particular, because that is our audience largely,
Yep.
why they should have more private market exposure. And that's because public market companies are disappearing. You've talked about this a little bit before, but if you could help us understand what is happening and what's behind that phenomenon.
Well, a few things. When you think about the public world in the United States, I'll talk about that in
Mhm.
particular. I think, I don't remember if it was the last 15 years or last 20 years, some period of time like that. The number of public companies has been halved. 50% of what was there 20 years ago is there today. And I think a few things have happened, but one is being public has become far less attractive. There's just a lot of regulatory stuff. It's just a very difficult environment to be public and do anything and everything you want. The governance structure in the public markets is very different. You sort of have this board, you got shareholders. I mean, it's just a very convoluted governance structure. The second thing, though, that has happened on the private side, which I think is critical, yes, it's a better governance model. You can react quickly. You all are on the same page around equity value, but the perception that there's capital for private investments is so much greater than it was 15 or 20 years ago. I mean, think about this. You had OpenAI oversubscribed at a 500 billion valuation. You have SpaceX that's talking about getting a round of financing at an 800 billion valuation. 20 years ago, you couldn't do that. And I'm not saying whether they're worth that or not. I don't think that's the point. The point is you can get the capital as a private company. Why the hell go public? The whole virtue of going public is that you could have liquidity. You could have access to capital. You don't need to be public for any of that. In fact, in SpaceX, what I read is that they are going to offer inside shareholders the ability to monetize their equity, which is exactly why you would have wanted to go public. You simply do not need to go public anymore. So why go public unless there's very little upside left and you figure I might as well get out as much as I can, which is why a lot of these companies end up going public. You've lost all of that upside. So this is not something that is unique to this year, or it's a big structural change in the way finance is conducted around companies. And I don't think it's going to change. I just don't see it changing, at least over the next 5 or 10 years.
I've also noted, and you've talked about this, I'm not sure if you have the data in front of you, but my understanding is private markets have outperformed public markets by a somewhat wide margin over the last couple decades. Can you help us understand that outperformance and whether there are certain pockets of the private market that have been especially rewarding?
Yeah, so private markets have outperformed over longer periods, 20 years, over that period of time. I will say that over the last couple of years, private equity, so all we're talking about is equity, has not outperformed the public markets. And largely because the public markets have been driven by the performance of 6 or 7 AI companies everybody knows about. You don't have those companies in the private world. And so when you have something like that happening on the public side, then private is going to struggle to outperform. We've had periods like that before. I think in 09 and in 16, you had private equity underperforming publics. It's normally been a fairly short period of time. And it's not even so much that there are pockets of private equity that underperform or outperform. It's that the entire set of assets, either under or overperform. But we're in a period right now where the last 2 years have not been great relative to public performance. And I think the question, as you probably heard me say in other contexts, is if the 7 AI stocks continue to go up 20% a year, yeah, I think private equity will continue to struggle versus public. But interestingly, do you think that's going to happen? In private credit, that is not true. Private credit has outperformed public credit over the last, I think every year for the last 20 years. It's just been the most consistently outperforming in terms of that particular private market. So it depends really if you're talking about equity or credit or some other part of the private markets.
Let's just double click on the private credit, because that is a huge and growing area. And this almost feels like old news. It definitely feels like old news. But of course, there was the First Brand situation that happened in the fall. The market panicked in response. Are you seeing any cracks in the private credit market? Are we seeing some signs of weaker underwriting quality? What should we make of that?
Yeah, let me rant for a minute. So
go for it.
the whole First Brands, and there were 2 or 3 other bankruptcies around it. Everyone went, private credit is a problem. If you look at who the lenders were in that case, it was not private credit. It was banking institutions. I think the argument should be banks shouldn't be lenders. And you'd probably be right if you said that. The private credit world today, while there's all this talk about it being in a bubble, we're just not seeing, sort of pressure at companies and therefore pressure in terms of credit standards. Are there easier terms in the credit markets today than there were 2 years ago? Probably. Are they at a point where you go, oh my gosh, they're just throwing money out and they're not even looking at what they're doing? Absolutely not. We're just not seeing that. And so I think this notion that private credit is in a bubble is not true. It's probably a reflection of a couple of things. One is, Jamie Dimon said there are cockroaches and therefore you have to watch out. I don't know in JP Morgan's portfolio, maybe there are. We're just not seeing that in the private credit world. There's also, because I always have to say something negative, right? Because we're finance people, so we have to talk about bad things. there is a lot of AI exposure going into private credit portfolios. And so I think as you're building your portfolio, you need to make sure that you have some diversification away from a complete AI portfolio around private credit. But I think this notion that private credit is in some sort of difficulty because of lax standards or looming defaults, we're just not seeing it in the data. And so I don't, and by the way, in terms of a bubble, so it seems to me that to call something a bubble means that it is in an unsustainable state. I don't think the growth of private credit is at all unsustainable. I think it is taking market share away from banks. It's taking market share away from the public side, the public debt side. I do not see that trend reversing. I really don't. And it's not just because it's the industry, I'm involved in on the private side. It's just the drivers of that are things that, again, are going to probably keep going for the next 5 or 10 years.
Is AI in a bubble?
That is, I don't know. I would say, so let's divide the question into a couple pieces. The first is the valuation of AI stocks in the public market in a bubble? I think the odds are probably still marginally that it's not in a bubble. Marginally. I think that there is an argument to be made that the adoption of AI is not going to justify the amount of money being spent. If that is true, you're going to have a real significant market correction. But is AI as a technology, is AI as something that will change the way you and I operate every day a bubble? No. It may not happen as quickly as these valuations say that it will happen, but I think it'll be a little bit like the internet, where we wake up, 5-10 years after the kind of 2000 bubble burst and go, my God, that changed everything. I do think that will be the case in the AI part. But I think to your more specific question of, are these stocks at prices that are assuming everything goes absolutely right? They are. And I think it's 55-45 that the market's right. That's, people need to understand that there's a huge risk around that from an equity value perspective.
Thank you to our partners at ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information.
You have said that all of the AI implementation will happen on the private market side. Can you elaborate on what that really means and what we can do with that as an investor?
Yeah, it was my usual hyperbole when I say all. I think as you look at where are the companies that are going to accrete value for an investor from the implementation of AI, they're not on the public side. The public right now is all around those giant large language model companies, Google, Meta, all of those. They are implementing a very specific, the way to think about it is almost like they are building the enormous electric plants, the power plants. But who's going to deliver that power and who's going to use that power when it gets out into society, into companies, into consumers? Those companies are going to, and those developments are going to come from the private side. That's what you're already seeing in the venture capital world, in the growth capital world, and in the buyout world. What you're seeing are companies that are implementing those things to enhance either their growth or market share or whatever they're doing. I was with the CEO of a public company who said to me, Mario, let me explain how this works at a public company. And this is a pretty big company. He said, it takes me 2 years to get a budget to implement AI. Okay, fine, I do that. And let's assume I do it because it's going to kill my earnings for a quarter or two, but let's assume I'm going to do that and the market is okay with it. I do it, and now it's going to take me another 2 or 3 years to do another budget to implement a new AI program. This for a technology that is changing every 6 months. He goes, you private people you're going to trample me because you're going to keep switching and applying and doing things more creatively than I can ever do. And so as we think about where do you want AI exposure, I think you want it on the public side for those semiconductor and LLM shares, stocks, business models. I think you want it virtually everywhere else on the private side. And again, marry that with the first thing we talked about, which is those private companies are going to stay private longer. They're not going to go into the public world so that you can have access to them until they are hugely valued. And so I look at that and think, okay, if you want a really diversified portfolio, or either around AI or with non-AI exposure, you got to be doing it in the private world.
Outside of AI, where do you see some underappreciated opportunities right now? What are you really bullish on at this moment?
On the private side?
On the private side.
I still remain bullish on secondaries. I know they have a bad name because everyone goes, that GP-leds are, that can't be a good thing. But if you look at a market where you have a lot of limited partners and general partners who want to sell some assets, and you have on the other side a group of buyers who have far less capital than the amount of supply that wants to come into the market, I think the supply-demand imbalance is awfully good in that part of the market. So I find that to be an interesting dynamic and one that I still believe investors, public and private, underappreciate in terms of the dynamics going on in that market. I also like the infrastructure market. I do believe that even with all the talk in the United States about, climate change doesn't exist and green energy doesn't matter, the amount of change coming to the energy world, whether in the building of nuclear power, even in the United States, the amount of delivery systems, the grid that needs to be changed around the world just makes for, I think, more interesting opportunities. Again, a supply-demand imbalance. So those two really strike me as places where people need to take a hard look at how they want to think about that and position that in their portfolios.
Okay, let's talk geographically. I'm super curious for your take on Canada as an investing, a jurisdiction to invest in. I was noticing your team recently grew your office here in Canada, grew your team, grew your AUM. Why are you planting a bigger flag here in this country?
Well, I have good news and bad news.
Okay.
Sorry.
It's okay. Shoot.
You want me on here because I want to speak honestly.
Yeah, exactly.
I think there is a lot of capital looking for a home to invest in Canada. And so I think from anyone like us, it is an interesting market to look at in order to have people who want to invest capital globally. I think as a place to invest, I think Canada over the next couple of years is going to struggle for the same reason a lot of places outside of the U.S. are going to struggle. And I'm sorry to say it because of U.S. policy. Canada has been very dependent on the U.S. As a trading partner, as an ally, as a business partner. And, I don't need to tell you the news. Being a trading partner of the United States today has some ups and downs. And I think for Canada in particular, for whatever reason, the U.S. just isn't willing today, the Trump administration is not willing today to cut it any slack in terms of saying, hey, yeah, I know you're really dependent on us, but over time, we don't want that to happen. They're saying we don't want it to happen today. And I think that will have a real impact on the Canadian economy for the next year or two. The Canadian economy will adjust, but it's going to take a couple of years. So I think as an investment opportunity over the next couple of years, I think people have to be very careful around Canada because of the outsized impact of American policy on Canadian industry. I wish it wasn't true. I mean, I wish, but I think as an investor, you'd have to look at that and think, okay, what industries am I interested in? I think there will be some. So for example, right now you can see in the United States, the Trump administration is pulling back on tariff pressures and industrial policies that can impact prices to consumers. So I would say that the impact of tariffs are going to be diminished in Canada over things that might increase prices in the US dramatically today. But even so, I just think there is a cumulative impact on the Canadian economy that needs to be seen. And I just think it's going to make it a struggle in terms of what industries you invest in.
You know, Hamilton Lane, I was going through some of your news releases, and what really struck me was that I believe, correct me if I'm wrong, that Hamilton Lane was one of the earliest private market firms to offer investment vehicles for individuals to invest in the private markets. Evergreens is a good example. I mean, there are plenty of firms out there that have evergreen options, but my understanding is Hamilton Lane was one of the first movers. What did you see that other firms didn't? Or what did you see before they saw it?
I think we saw a couple of things. One was that there really was an increasing demand among retail individuals, high net worth, for exposure to private markets. Before, I would say it was almost, lip service is the wrong word, but there wasn't this incredible demand for it. The second thing I think that was more important is the evergreen structures developed in a way where you really could offer exposure to retail high net worth investors in a cost-effective way. The products before, in my view, were not really cost effective. They ended up costing the investor, the retail investor, too much money. It just the net return just didn't make sense. I think some of these evergreen structures are put together in a way where you get immediate exposure to a good set of assets at a price that makes sense for everybody. And to us, that was always the key consideration was you can raise money and then a year later the investor goes, what the hell? Like, what did I just invest in? This sucks. And you're not going to raise another penny. But if you can do it in a way where everybody feels like they're getting the right return with the right product, and I just think that these evergreen vehicles are underrated in terms of their ability to deliver that.
Mm-hmm. Well, you know, you've also said though that these products have not really been tested in a down market. Can you expand on that? Do you have any predictions how they might operate in a down market?
Unless history reverses itself in a down market, some of these products will disappoint. And I think that investors need to be pretty careful around picking managers that they think have been through cycles, know how to manage liquidity and get money back to people. But I think we're fooling ourselves if we think that in a down market, one firm is going to go way up and the others are not going to. I mean, in a down market, all assets tend to lose some money, right? That's just kind of especially we're in equity. It's not like I have people tell me private equity is not really equity. Of course it is. Like, what are you, crazy? Why does it say equity in the title? So I believe, and I don't want this to happen, but I think it will be good for the industry for a downturn to happen because you do need these products tested. And I do believe that the better firms will come out of that with both stronger client base, a stronger, more robust set of evergreen structures. I just think that's how the world operates. It's how markets have always operated. It's in downturns. Remember I said at the beginning that I thought private equity became a more established way of investing through I never want to go through the great financial crisis again. But in hindsight, it was that event that solidified for people who they want to be with and what kind of assets they want to be in. And I think with the evergreen structures, we will go through the same process. Of course, it depends. I'm not at all predicting a great financial crisis, but at some point, right, we'll have a bear market. Like we haven't repealed the laws of economic history, have we? So when that happens, we'll all hate it and we'll all say this is horrible, but it won't be. It will be part of the natural up and down of markets. And I think we do need that for these evergreen vehicles.
You brought up the L word during that conversation, liquidity. And some people would call it a criticism of private market investing. Some people would call it a trade-off. Obviously, there is not as much liquidity in the private markets as there is in the public markets. You have, I love this line, and I feel like I'm just quoting you back at you, but you have all these great one-liners, Mario. So I'm just going to.
It's probably all I have, you can tell.
I heard you say, quote, everyone wants liquidity so they can make a big mistake. However, if I could push back against that, some people need liquidity because bad stuff happens. You know, a retail investor could lose their job. Their child could demand an elaborate wedding that they need to finance. So how do you navigate the liquidity needs of retail investors?
Well, I do think I'll start with that first quote. Thank you for quoting me. It's always nice to be quoted. It is true. If you look at, again, go back to that example of the great financial crisis. I will argue that the reason private equity was so highly regarded is because we didn't give people their money back. We didn't let them take their money out. Whereas they sold at, the worst possible time in every other place they could sell. And so I do think as a fundamental premise, people need to really examine why they want liquidity so badly. They want it to feel better. They don't want it because it makes any investment sense. They want it to feel better. So I think you need to start with that. I completely acknowledge that people need liquidity at certain times for unexpected reasons. They just do. And that's why, frankly, I think the evergreen vehicles are genius because they allow people to get liquidity at times they really need it. That's the part where we miss too often. People view them as kind of like, oh, they're a little bit like public stocks. I can get in and out when I want. No, you shouldn't. You may be able to for a period of time when things are good. But in order for these things, I think, to function as well as they should, people will need to recognize that they are essentially illiquid unless you really need the money or you're doing some big portfolio reallocation. And by the way, even in the worst of the, if you need liquidity, particularly during good times, you can always get it. That's why the example, I'm going to push back a little. The example the example you give me of, oh, they need their money because I think you've been living my life. Their daughter needs a really big wedding.
I did robust research for this. Just kidding.
I've just lived through that. It's unbelievable what you pay for in a wedding. It's crazy, but we digress. Most of the times that people need money for a wedding, for a house, is not at a time when the markets are cratering. I think a lot of times people give that example. It's almost the straw man. Usually when that happens, since markets are in a bull or neutral phase 80% of the time, 85% of the time, you can get your liquidity. It's not a problem. The real problem around liquidity is basically people want it when they don't need it. I get that there may be people who need the money as the market's cratering. But on that, I don't mean to be presumptuous, but part of it may be they put too much in illiquids. You do have to have some portfolio construction. And the other part is, even in bad markets, you can get some liquidity if something horrible happens. So I think we're taking smaller examples of when people need liquidity and immediately applying it to the worst market conditions. I would say, so we've had experience on evergreens for the last 6 years, 7 years now, whatever it's been, I don't even remember. Everyone has been able to get money out when they need it. I haven't had anyone call and say, hey, asshole, my daughter's getting married. I need the money. You're not giving it to me. It just hasn't happened. So I really struggle with this liquidity.
So there has been gating in some funds here in Canada. It's made the news. Obviously a turnoff for investors when they read about this. To what do you attribute the need for gating? Is that a mismatch between product and investor? Is that poor education of the client? Why does this happen?
I think it's a combination of things. I'll blame people like us, the manager, first. I think sometimes I think one of the more important things as you build evergreen platforms and portfolios is understanding the client base. I think there are certain clients, as soon as you walk in, that they're traders. That's what they are. And they are going to trade your vehicle. And if you have a large number of traders in your structure, you are doing a disservice to everyone else because they are going to come in and out as rumor and it almost doesn't matter what the portfolio is doing. They are reacting to something other than the portfolio in a lot of cases. So I think that's number one. Number two, I think if you look at some of the cases where things got really didn't do well, leverage. It was a really poor handling of the money by the manager, either with too much leverage or insufficient diversification and no understanding of cash management. So again, I go back to, you better have somebody that you think can cash manage and knows what they're doing around cycles and portfolio construction. And then finally on the investor, because now I blame the manager for everything, the investor needs to understand that one, gating can happen, really understand what product you're investing in, and get educated around it. And that's a responsibility of both us as managers and the client. Get educated. I think I've said this in other contexts. It took the institutional world 20 years to figure out how private markets operated and how they work. It took 20 years of education in market cycles. I think it's unrealistic to think that the retail high net worth investor is going to figure it out in a year or two, the way we sort of have all assumed, they must understand it because institutions do. No, retail investors are going to take some time to get educated. And that's why I think a market cycle will be helpful here, because that's when you really learn, how do these things behave? How do I behave when markets, when everything hits the fan? How do I behave? But I do think the education piece is a critical part of the high net worth channel.
Mm-hmm. Talking about portfolio construction, I know every investor is a snowflake, but you've brought it up several times. There's that 60-40 construction that we've talked about for eons. When we're talking about private market exposure, do you have sort of a rule of thumb for investors about how much of their portfolio should be invested in the private markets?
I like the snowflake. I'm going to use that one, except it has a different connotation now in politics.
I know, there's several connotations.
No, I know, but we'll take it. We'll take it the way you meant it, with everyone being unique, and they are. But I do think so. I'll start with my position on it, which I understand is out there. I think most people should have 50% of their portfolio in illiquids.
Wow.
And that's just not equity. That's equity, credit, real estate, everything. But it goes back to my fundamental premise of people overvaluing liquidity and the need for it. So I would start with kind of where and I think the world will get there. I had said, so I forget, people do quote me, which I wish they wouldn't sometimes on this one. This was a few years ago. I said that I think by 2030, most portfolios will be 50% illiquid. And people were like, you're insane. I think we're getting to that place where there is a more accepting view that up to 50% is not a crazy number, particularly with what you talked about earlier, which is the number of public companies reduced by so much, where your opportunity set is really on the private side. But I would say that if you think about the different parts of the private markets, I think most people are comfortable with, call it 10% in real estate. I think people have a way higher comfort level with real estate than they do with almost any other illiquid asset class, because they know about homes, they know things that they can touch and feel the real estate. I think you've got to have 10 or 15% in credit, particularly if you have any kind of bond portfolio. And then I think you've got to have the other 20, 25% around equity and infrastructure, things like that. I just think you do in this world.
That is really fascinating. As you're talking, you're reminding me of another titan of private market investing, Bruce Flatt, Canada's own. Bruce Flatt, the head of Brookfield. He recently said that he thinks that in 25 years, all capital not required for liquidity purposes will be in private markets. Do you agree with that assessment?
Yeah, I guess we're saying a little bit the same thing.
Mhm.
I don't think it'll be 25 years. I think with things like, as I mentioned earlier, the SpaceX at 800, the amount of capital that can be absorbed in private markets in lieu of what was formerly public is just going to drive all that. You listen to Mark Rowan at Apollo, and he talks about basically the private markets, people like Apollo and Blackstone will take over what was being done by the public markets on the credit side. So as an investor, again, you can, and I've said this, I mean, private markets people are not the greatest people in the world. You do not want to have dinner with most of them. I mean, they're just not the most, you just don't want to. But the point is not whether they're likable. The point is, as investors, where will return come from for your portfolio? And as the world becomes more private, unless something dramatic changes that, so some regulation that says, okay, the private world now can't be private, and maybe that happens in 10 years, I don't know. You as an investor don't have much choice but to say, I'm either going to play in the illiquids and figure out how to play it, or you just say, I'm never going to do that because the risk is too high or I don't like illiquidity. But that's a huge bet in terms of where the world has moved for the last 10 years and is going in the next 10.
Mhm. Do you think there is an area of private market investing where the retail segment actually has a bit of an edge? Because scale is so important.
Well, look, you've seen some of the headlines recently about the international, is it the ILPA, Limited Partners Association, uh, having some concerns about the evergreen structures and how that impacts the institutional investor. I do believe, and I said this before this has all happened, the innovations and the growth in private markets is going to come from the high net worth, evergreen structures and channels. It will not come from the institutional side. And so, yes, I think that you will begin to see products that are developed with the high net worth channel, the evergreen structures in mind, and it will create potentially, probably, an advantageous structure for that segment of the world to invest in. I think that's where things are going to change in favor. Because if you tell me that and I'm saying you, but I'm hearing in 10 years, there will be trillions coming from the retail side. Well, of course, the market's going to adapt to that and provide things that are, we'll call it more beneficial, more favorable, more appealing. Yeah, I think the dynamics of the market could change.
Mhm. Well, listen, I want to thank you so much for taking time out of your busy schedule to talk to us. This was such an interesting conversation. Thank you so much, Mario.
No, thank you. It's been a pleasure.
That was Mario Giannini. He is executive co-chairman of Hamilton Lane. He was joining us from his office in Philadelphia. Coming up, the next episode of our special series on alternatives, we're going to be talking about the classic alternative investment, real estate. Make sure to tune in to find out how retail investors can play in this space. Thanks for watching.